I think we've got a good little group of people online, so I'll jump right in. I'm coming at you from outer space today. Um, so first off, appreciate everyone taking the time to join. My name is Ainsley Woods. I'm a senior analyst with Structure Research. We're an industry-focused research firm that covers the internet infrastructure space, so think cloud, data centers, and the ecosystem that surrounds that. Phil and I are actually based in Toronto. So Toronto is a market that we know quite well. We've just actually recently published an update to our data center report. So I'm excited to share some of the findings with you today. Okay, so here's a quick overview of how the presentation is going to run. I don't want to take up too much of your time, so I'll take you through a high-level overview of the Toronto market in about 20 minutes or so, and then I'll set aside some time for Q&A at the end. So if you have a question as I'm going through, feel free to pop it in the Q&A box as I go along, and Phil might answer some of them in the chat, and if not, I'll get to them all at the end. I also want to note that this presentation is being recorded. I think it will be posted to the Structure Research YouTube channel later. I know a lot of these slides have a lot of numbers on them, and I'm going to be going through them pretty quickly. So if there's anything you want to take a closer look at the end, you will have the opportunity to go back and take a closer look. Okay, so I'm going to start by looking at the Canada as a whole. So there are three major data center markets in Canada. We've got kind of Toronto in the center of the country, Montreal over on the eastern side, and Vancouver on the west coast. Toronto is the financial center of Canada, and it's home to a good chunk of large enterprises and major tech companies that you don't see in other parts of the country. But one of the major challenges facing Toronto is the underlying cost of operating in this market. Real estate here is becoming increasingly expensive, and the cost of power is pretty high, especially when you compare it to the neighboring province of Montreal. So I think power is about 10 or 11 cents US here in Toronto, and about 2.5 to 5.5 cents in Montreal. So quite a big difference. And because of this cost difference, Montreal saw the first wave of cloud buildouts in Canada. But this dynamic has now started to shift as serving the critical mass of enterprises and end users just becomes increasingly important. So we have Microsoft, Google, Oracle, and IBM all having localized cloud infrastructure in both Toronto and Montreal, with Google and Oracle entering the Toronto just this year and last year. So notably, Amazon is still not in Toronto, and I kind of have to wonder how long they can continue to serve the entire country from one region in Montreal. So I think it's only a matter of time before we see them in Toronto as well, or even farther west in a market like Vancouver. Canadian data sovereignty continues to grow in importance. It's becoming, more and more important to house some data on Canadian soil in a colocation environment, even if the rest is in cloud. But even if there are Canadian cloud regions, there aren't redundant fiber routes that go through Canada only. Most do dip down into the US. So I think that could help contribute to colocation demand in Canada, particularly interconnection-oriented colocation. Notably, there are no cloud regions in Western Canada as of yet. This area of the country is still served from Montreal and Toronto or other cloud regions on the west coast of the US. So as data sovereignty and latency become more of an issue, I think it's likely that Vancouver is going to start to see some cloud activity. For that reason, Vancouver is kind of the next Canadian market that's on Structure Research radar. We're hoping to get out there in 2021 and publish a report on the Western Canadian markets of Vancouver and Calgary in the first half of 2021. So stay tuned for that. All right, now jumping back into the Toronto market. As of 2020, we're sitting at about 385 million in market size, and that's in US dollars. We're forecasting a 5-year CAGR of 6.1%. And again, this growth is going to be driven by the hyperscale vertical. We're hearing that the retail colocation market in Toronto is pretty slow right now. Deals are coming in the single-digit cabinet range. And we're hearing that some of this has been driven by delays and deferring of IT decisions due to the pandemic. And we're also starting to see kind of a separation between interconnection oriented colocation and the more traditional retail colocation that's focused around space and power. So we're hearing that when deals are coming into the pipeline now, conversations are starting around cloud connectivity rather than space and power. And while the retail colocation market is currently a little slow, I think hyperscale cloud is going to have a positive spin-off effect on this market that will sustain growth going forward. I think there'll be a rebound in retail colocation in, we'll see like the next 3 to 5 years as enterprises kind of shift to hybrid IT models, realize that not all workloads are suitable for the cloud and end up pulling stuff back into colo. But again, not all providers in this are going to be winners. We'll see that interconnection oriented providers have a distinct advantage. I also want to say that Structure Research has recently updated the way that we measure data center capacity. So in the past, we've been focused on measuring what the current built out capacity in a market is, but we've now expanded this view to include max built out capacity and total capacity. So, you see from this little diagram here, the current built out capacity is the space within a data center that's currently live and operational, sometimes also called fitted out capacity. And then when we refer to max build-out capacity, we're taking this one step further and talking about what the capacity is going to look like when this data center is fully built out and all phases are online. And then total capacity, again, takes this one step further and includes capacity from confirmed secured sites, land banks, and data centers that are under construction. So, if you see here in this spot, there's a little bit of vacant land here. It looks like they have room to build out in a campus style environment. That capacity is going to be captured in total capacity. So taking that and applying it to the Toronto market, we've got just under 200 megawatts of capacity that's online and operational in 2020. And I'm forecasting that the market's going to be growing at about roughly 30 to 35 megawatts a year for the next 5 years. And again, in the Toronto market report that we have published, we'll break down this capacity between what's retail, what's hyperscale, what absorption rates look like. So if you do want a little bit more detail on that, we could talk about the report. Here in Toronto on a megawatt basis, the current built out occupancy is sitting at about 79%, and on a square foot basis, occupancy is closer to 83% occupied. And we'll see these occupancy rates kind of stay high and maybe creep up as hyperscale starts to take over more of the market. Toronto's not really a place where speculative builds happen. Most capacity is only brought online to serve pre-established demand. Here's a little overview of the data center distribution in Toronto. The Toronto market does cover a lot of ground. This kind of little box in the center is what's considered the downtown core of Toronto. This is where much of the network density resides. This is where the 151 Front Street Carrier Hotel is located, and where the kind of interconnection focused operators like Equinix and Cologix have set up shop. The first kind of wave of wholesale build-outs in Toronto kind of started to cluster in these northern suburbs of Markham, Vaughan, Richmond Hill, even as far north as Barrie. And now we're starting to see Etobicoke crop up as the next kind of wholesale cluster, with Compass data centers and Urbicon both building in this area. And I think that it's likely that these hyperscale type builds are going to stick to the northern and western suburbs rather than going further east, just because it's more convenient highway access to the airport and better access to fiber. Taking a look at the cloud on-ramps in Toronto, early on in the industry, carrier neutral was kind of seen as the way to go. You needed to be able to provide your customers with access to a variety of network providers. Now carrier neutrality is probably just considered table stakes, and cloud neutrality is the way the industry is trending. Customers now increasingly adopting hybrid and multi-cloud strategies. So data centers need to be able to provide connectivity to a wide range of public clouds. In terms of the cloud on-ramps in Toronto, Cologix and Equinix are leading the way here. Megaport is actually also making headway in this market. The Megaport exchange is now currently installed in about 10 data centers in the market. Now we can take a look at this map again, but this time looking at it from a hyperscale perspective. So we've got kind of one Azure node in the downtown core, but mostly wholesale operators are clustered up in these northern and western suburbs. Toronto's still relatively early on in its cloud build-out with 56.4 megawatts of contracted capacity, much of this only coming online in just the last 18 months or so. And again, the full Toronto market report will break this down further into what clouds are taking up how much capacity, if that's something that you're interested in. We have not heard any talk in the market around hyperscale self-builds. I think time to market remains critical in Toronto, and many of the cloud providers are already working closely with existing operators. So I think this trend toward leasing and colocation facilities is something that's going to continue. AWS is now the only hyperscale cloud platform without infrastructure based in Toronto. It continues to serve all of Canada out of Montreal. So again, I think it's only a matter of time before we see something from them in Toronto. Taking a look at the competitive landscape and how it's kind of shifted in Toronto over the last few years, we've kind of seen the telco sector exiting the colocation business in Toronto. Bell Canada has sold its nationwide portfolio to Equinix. Cogeco's exited the infrastructure services business to Digital Quality, and TELUS has stopped selling colocation. So Rogers remains the only telco in the game for now. Digital Realty was previously only offering wholesale colocation in the Toronto market, and they have now jumped into the retail colo game, and they have a 2 megawatt retail data hall, and they have on-ramps in the cloud on-ramps in the facility now, so that's being targeted to kind of drive interconnection uptake. And then we've had a couple new market entrants over the past year and a bit. Compass Data Centers has entered the Toronto market. They entered the Canadian market last year through acquisition of Montreal-based operator Root, and this year have moved into Toronto. And Server Farm has also entered the Toronto market. And I'll also touch on a little bit about how the COVID-19 pandemic has been affecting the Toronto data center market. So like we've seen in many other markets, we've seen IT related projects being put on the back burner as companies focus on their core essential tasks. We're starting to see that the things that have kind of been put on hold are picking up again. Long term, I think the pandemic will likely have accelerated the need for outsourced infrastructure and cloud adoption. We've heard rumblings of a few sale leaseback opportunities in the market. These could end up being pushed forward given the pandemic environment and the need for enterprises to start finding more operating cost efficiencies. In terms of construction, COVID has delayed construction projects initially, with a couple expansions and new builds coming on a little bit later than anticipated, but it seems that the issues around supply chain have been largely resolved and things are kind of moving ahead as normal now. We were hearing from providers across the board that the usage of remote hands has increased since the beginning of the pandemic. Also, customer portals have seen increased usage as customers just really want to procure services and manage their infrastructure without actually having to go into the data center. Virtual tours have replaced in-person meetings. I know Phil and I did a couple of these virtual tours as we were putting this market study together, so it's kind of interesting to experience that. And we were hearing from providers that it hasn't really impacted sales too much. And healthcare, government, and educations were all sectors that hadn't seen a huge amount of data center usage in the past, but more deals from these verticals have entered the pipeline, mostly due to the pandemic, accelerating things like online learning and telehealth. So we are seeing a little bit more of those types of deals in the pipeline now. Okay, and that about wraps up my presentation. So Again, if you want to check out any closer details, we do have the Toronto Market Study report on the website here. And if you have any questions about that, feel free to reach out at the email on the screen.